Good afternoon and welcome to dissects Asian Midday Market Watch. It is the 7th of June and I'm Brian Fernandez. We are joined today by Kelvin Wong, Senior Market Analyst at Oanda, coming to us out of Singapore. Kelvin, it's always great to have you on the show on the Friday.
My pleasure, Brian, and happy Friday to you too.
Now, Kelvin, before we get your insights, let's take a look and see how markets across the region have been performing in the first half of the day. We start with the ASX All Ordinaries, that's up 0.41%. The Kospi is up 0.95%. The Nikkei is down 0.35%. The Straits Times Index, where you're at, is up 0.42%. The KLSC is up 0.18%, where I'm at. Shanghai is down 0.27%. And rounding out the numbers, we got the Hang Seng, which is down 0.63%. Kelvin, your views on the mixed market performance in the first half of the day?
Sure. So if you look at the current situation right now, let us start with some key data that's out from Asia first. Is number one, we do have a slew of positive data out from Japan. So over at Japan today, we do see the release of their household spending. So that is something like a proxy of retail spending. So household spending on a year-on-year basis actually came in better with expectation, but it's definitely better than the previous month of a negative 1.2% year-on-year growth decline. So for this time round, for April, it actually managed to hit a positive territory at 0.5% year-on-year. And that is actually the first, we call it a positive year-on-year growth on a monthly basis since February 2023. That's close to about a year. So what it implies to us that the Japanese consumer are on the path of having a much more confidence in adjusting their spending behavior, shifting away from a deflationary mindset that has been entrenched in them in the last decade or so. So that's actually in line with what Bank of Japan wanted in order to further normalize their interest rate policy in line with the rest of the world. Moving forward, what we have over here also in China, China data is rather mixed, I would say, in my own opinion. Why? Because exports numbers are better than expected. The export year-on-year, 7.6%, going to expand from 1.5% printed in April and also above expectation of 6%. So that actually implies that the external demand for China goods and services remains resilient. But however, the state of domestic demand or internal consumption by the Chinese remains lukewarm or lackluster. By looking at the imports number, imports actually fared worse than expected. So market expectation was about to come down from 8.4% year-on-year printed in April to a slower growth at 4.2% for imports. However, the actual imports came in at 1.8% year-on-year. So that actually implies a rather mixed data, and also implies to us that China consumers are still keeping on a very tight latch in terms of their wallets. So that could also prevent the Chinese economy from getting rid of that deflationary risk spiral that is still somehow or another looking around the corner.
Now, Kelvin, I want to look back to yesterday, and the ECB has blinked and has cut rates.
Yes.
What has the impact been on FX markets?
Yeah, precisely. So if you look at over here, is that the ECB rate cut yesterday, I mean, the first, if you look at from the deposit, actually there's two rates. One is the main refinancing rate. So the main refinancing rate was cut the first time since 2016. For the deposit rate, they were cut for the first time since 2019. So each of these two benchmark rate were cut by 25 basis points. But this interest rate cut is being well telegraphed way back then in the previous, after the previous ECB meeting in March. So it doesn't have any impact on the market as per se. But what's actually impacting the market on the FX market was there was a surprise that ECB actually implied a less dovish thinking among the official by looking at the latest ECB inflationary trend projection that was also released yesterday. So all their inflation trend projection for the year of 2024, 2025 to 2026 or actually revised upwards as compared to the March forecast. So what's interesting over here is that for their 2024 inflation trend forecast, that's core inflation excluding food and energy, they raised it to 2.8% year on year for 2024, up from the previous projected or projection that was released in March. That's 2.6%. So that's up by 2 basis point. Similarly, up by 1 basis point was their 2025 forecast. For this time round, they're expecting to inch up 1 basis point, 2.2% from earlier forecast of 2.1%. And what's interesting over here is that 2026, they remains the same at 2%. So in the minds of ECB officials, it seems to us that there is some kind of fear in them that inflation pressure in Eurozone may stay at an elevated level higher than what market participants want them to be. So by looking at the magic number of 2%, that is the comfort level that major central banks, including ECB, wanting the economy to hit this 2% level before we saying that the evils of inflation pressures are out of the woods. So the only way hitting down to 2% comfortably based on ECB's thinking right now is only in 2026. So from now, at least until end of this year, until early part of 2025, there is actually a chance that ECB may continue to actually stand pat after yesterday's so-called historical rate cut. So implication on the FX market, we start to see weakness across the board in terms of dollar weakness across the board against the major pair.
Now, finally, the big news of the week, really, which is what markets are waiting for. The US non-farm payroll numbers are expected later today. What is
Yes.
your view on the expectations around the non-farm payroll numbers?
Yeah, so if you look at right now in the last three non-farm payrolls numbers, the expectation versus the realized number is way off mark in terms of the variance. That means going forward, it seems to us that the last 3 months forecasting the correct number to actually within that normal variance seems to be pretty much challenging. So last month, we do have a very strong outlier number of 300 over K of jobs added. That's way beyond expectation. So what we could see over here is what market. Pardon me. Let me rephrase it. So last month, market is expecting this 243K jobs added. Okay, but market came in way softer than expected to 175K. All right. So this time round, after a rather weak showing for the April numbers, market expect to have a slight upward adjustment by 10K to 185K. And do not forget over here is that prior to this Friday non-farm payroll release, we do have the privately organized organization compound numbers, which ADP came in weaker than expected. So there's actually a slight risk that the non-farm payroll number may actually came in below what market is expecting right now, which is 185K. So if that particular scenario unfolds, that could actually means that, i.e., we do have a stronger, we call it odds of the US Federal Reserve to maintain its interest rate cut that is being more or less fully priced in for the September FOMC meeting. And also there will be a possible cut before the year ends, that is in December FOMC meeting right after the US presidential election. So if this particular signal get solidified by a not so red hot job number, that could actually add a further intraday downside pressure on the US dollar. But however, if the market start to surprise us again this time around on today, we start to see a very strong job number about 200K and above or so. That particular interest rate cut for the December meeting will definitely be reduced by a fair bit. So that could actually start to see a bit of dollar recovery coming back into the picture, at least on an intraday basis.
Kelvin, on that note, thank you very much for your insights. Thanks for coming on the show.
My pleasure.
Now, we've been speaking to Kelvin Wong, Senior Market Analyst at Oanda, and this has been dissects Asian Midday Market Watch. I'm Brian Fernandez. This show will be on our website, www.dissects.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.